Welcome back to Switzer on Sky News Money. Reporting season is always an opportunity for a fund manager to reassess how they're investing. Hugh Giddy is a fund manager at respected firm Investors Mutual, and I caught up with him earlier this afternoon. It's about the Mutual Australian Share Fund and the Concentrated Share Fund that you're responsible for.
Well, the Investors Mutual Australian Share Fund is a bit more plain vanilla benchmark aware fund. We still have a significant active orientation within that fund and a reasonably high tracking error. The concentrated fund, however, is much more benchmark unaware. The tracking error is higher, there are fewer stocks. But interestingly, both funds are much less risky than the market index. We have much less volatility in both funds, and although the concentrated fund is often seen as a more risky, supercharged version of market exposure, our concentrated fund that I run has a very low beta, very low volatility, very low drawdowns, and we believe that that's very attractive to a lot of people.
Do you change the stocks in the concentrated share fund very often?
Very seldom. I wonder how brokers even ever bother to take me to lunch, because I hardly trade. I think the principle of good investing is to find good companies that you can own for a long time, because when you do find a good company, it's sort of like a gift that keeps giving. The earnings go up, the share price goes up, you get a dividend, and the company continues to grow if it's well managed and in a good position. If it's a quality company with a competitive advantage, with recurring earnings, that's the sort of company we want to find. If you're buying something with the intention of selling it in a few months, you're fundamentally saying it's not such a good company, you're just seeing an opportunity in the price. And that's a little bit more of a speculative guess that the price will go up in a short period of time.
Do you have any exposure to energy, and if so, how are you playing energy stocks right now?
Well, we do have a small exposure to energy. We own Woodside and Origin. Origin's a combination of an energy company with its exposure to the APLNG joint venture with Conoco. But a lot of the business is actually utility, retailing and generating electricity and retailing gas in Australia. So it's sort of part utility, part energy company. Woodside's a very well run company with a great balance sheet and a very good reserve position on its assets, but yeah, both companies are subject to the fall in the crude oil price, and so we don't have a particularly large position.
Yeah, but you know, is your fund such that you can say, well, energy prices are down now, Woodside's a very good company, I'll get a little bit of extra exposure to it while the share price is down and out because of the oil price?
Well, it depends on your view on the oil price. If you think the oil price is down and therefore must rise again because of reversion to the mean, and your view is the mean is higher than the current level, then of course you'd be buying Woodside, depending where your view of the mean is and how quickly you'd get there. I do believe Woodside is a high quality energy company, and as I said, the balance sheet's very strong and the cash flow is good and so forth. But I have to say I'm not absolutely certain about the oil price. I have a lot more confidence about, for example, CSL having demand for its blood plasma products for the recombinants that it's producing for the vaccines, because I know people are going to get sick. I'm not absolutely sure about the supply-demand picture in oil. Supply picture seems to be pretty strong at the moment. There's a lot of shale oil being exploited. Costs of production are coming down. It might be that the oil price bounces, but I think there's also a chance that longer term the oil price continues to decline as we become more efficient at extracting oil, and you also get substitution in energy as people switch to things like solar.
Yeah.
So I believe you've got to look beyond just sort of where has the price been and where is it now, because you can also say longer term, oil used to be between $10 and $20 a barrel.
That's right.
If you just go back far enough, and so I'm wary about investing in things to a great degree where you have to make a lot of assumptions about things that are beyond management's control.
Okay, so you're going to go long blood, short oil. We get it, Hugh. All right. Given reporting season so far, have you changed any of your investment strategies as a consequence of what you've seen?
No, our investment strategy has been pretty much the same for the last 5 years, and that is that the global economy is likely to disappoint in terms of growth, and Australia to a large degree will be the same. You have households that are heavily indebted. You have an aging demographic, and older people spend less and borrow less than young people. And so the fundamental economic drivers aren't there supporting companies. Companies have to be have real innovative products, or they need to be in a very strong industry position, or something that really makes them able to rise above the fact that the economy is not giving them any tailwind, as it used to in the 90s and the noughties, where credit expansion was strong and the demographics were more favorable. So our investment philosophy has been to stick with the quality companies that may not be great beneficiaries of the economic cycle, but they're able to grow pretty much through thick and thin, maybe not so fast, companies like Telstra, but that they also don't go backwards if times are tough. And a lot of people have sort of tried to play the cyclical companies with cyclical exposure, and there really hasn't been that much of a cycle.
No.
The latest reporting season, a lot of companies have achieved some cost cutting and have received some cyclical benefits, particularly with the housing industry being quite strong. Companies which are beneficiaries of oil prices like Qantas. But in general, companies are finding it tough, and you can see that in the outlook statements. And reporting season so far hasn't been that great. The market's down, I think, about 4% in August, on the back of weak guidance from most companies reporting. So people are seeing it being pretty tough going forward.
Okay, so what is your favourite company play right now?
I mentioned it already, CSL. I think that's, there may be things that look cheaper, but in terms of a stock that you can really hang your hat on, it has tripled since we bought it 5-6 years ago. And yet I continue to hold a large position in the company because they have this fantastic R&D pipeline. They have a very strong balance sheet. The R&D spend is more than $500 million per annum, and that is really the growth engine of the business to keep growing the profits. When I say more than $500 million, that's in the context of profits of about $1.5 billion. So it's a very big R&D spend. It's all expensed, and I think that really allows the company to grow into the future in an environment where growth is quite hard to come by.
So that was Hugh Giddy, Fund Manager at Investors Mutual. After the break, we'll see how the very analytical ST Wong has analysed reporting season so far and what are his big tips as a consequence.